The $100 billion gamble. Why Big Oil said no to Venezuela. Imagine you're a CEO, and the President of the United States calls you into the White House. He's just pulled off a massive Hollywood-style military raid, captured a foreign dictator, and now he's offering you the deal of a lifetime. He says, "I've secured the country. It has the largest oil reserves on Earth. I want you to go in, spend $100 billion, and turn the taps back on." Most people would think you'd jump at the chance, right? Access to the world's biggest oil tank. It sounds like a gold rush. But in January 2026, when Donald Trump pitched this exact scenario to the executives of ExxonMobil, Chevron, and ConocoPhillips regarding Venezuela, their answer was a polite but firm no. Why? Why would oil companies turn down what looks like the opportunity of the century? The answer isn't just about politics. It's about rusty pipes, a specific type of sludge, and a calculator that didn't add up. Today, we're going to look at why the raid was the easy part, and why the president's math on Venezuela was fatally flawed from day one. To understand why the executives pushed back, we first have to look at what they would be buying. President Trump's pitch relied on a very common misconception that oil production is just about turning a valve. He assumed that because the oil is there underground, we can get it here into gas tanks in less than 18 months. But Venezuela isn't just paused. It's broken. For the last 20 years, Venezuela's state-run oil company, PDVSA, didn't just stop drilling. They stopped fixing things. When a pump broke, they stripped parts from another pump to fix it. Pipelines have rusted through. Refineries that used to process millions of barrels are now essentially scrap metal. Oil executives know that you can't just flip a switch on a machine that hasn't been oiled in a decade. You have to rebuild it from scratch. We aren't talking about a repair job. We are talking about a total reconstruction project. Analysts estimate it would take 3 to 5 years just to see a meaningful bounce in production, and maybe 15 years to get back to where they were in the 90s. When Trump asked for a quick win to lower gas prices before the midterms, the engineers in the room looked at their shoes. They knew physics doesn't care about political timelines. Then there is the oil itself. This is the part that often gets missed in the headlines. Not all oil is the same. The oil produced in Texas, shale oil, is light and sweet. It flows like water. It's easy to refine. On the other hand, Canadian and Venezuela's oil, it's extra heavy and sour. It's basically sludge. It has the consistency of peanut butter mixed with sulfur. You can't just pump this sludge out of the ground and put it on a ship. It's too thick. You have to build massive, billion-dollar facilities, called right there in the jungle, to dilute it and clean it up before it can even move through a pipeline. Most of those upgraders are currently offline or destroyed. So, the executives were looking at a double whammy. They have to rebuild the infrastructure to get the oil out. They have to build billion-dollar factories to treat the oil so it can be sold. And remember, digging for peanut butter is much more expensive than drilling for water in Texas. If global oil prices are low, which they are right now, it actually costs more to get Venezuelan oil out of the ground than you can sell it for. That's not an investment. That's charity. The trust deficit, the once bitten, twice shy factor. Now, let's talk about the elephant in the room. Trust. In the business world, stability is better than potential. Many of the executives sitting in that White House meeting, specifically from ExxonMobil and ConocoPhillips, have long memories. Back in 2007, they were in Venezuela. They built the rigs, they drilled the wells, and they spent billions. Then the Venezuelan government nationalized everything. They simply took it. The companies were kicked out, and their assets were seized. They lost billions of dollars overnight. So, when President Trump said, "It's safe now, I'm in charge, go back in," the executives asked a very simple question. For how long? Investing in oil takes 20 to 30 years to pay off. Even if the U.S. military secures the country today, who runs it in 5 years? What if the next Venezuelan government decides to seize the assets again? What if a future U.S. administration changes its mind? Without an ironclad guarantee, meaning the U.S. government promises to pay them back if things go south, The risk was simply too high. They call this being uninvestable. It doesn't matter how much oil is there if you can't guarantee you'll own the pump tomorrow. The flawed calculation. One side has political will. The other has market reality. The market reality side slams down. This brings us to the core of why Trump's calculations were flawed. He approached this like a real estate deal. I have the asset, the country, now I just need tenants, the oil companies. He thought the raid was the hard part. But in the energy industry, the raid is irrelevant if the economics don't work. Trump wanted to flood the market with cheap Venezuelan oil to lower gas prices for Americans. But here is the irony. The world is currently oversupplied with oil. We have too much of it. If these companies spent $100 billion to dump more oil onto a flooded market, prices would crash. That would hurt their own profits. It would even hurt the oil producers in Texas and North Dakota. So, the president was asking U.S. companies to spend their own money, take a massive risk in a dangerous country, to produce a product that is hard to refine, all to lower the price of their own commodity. It was a bad business deal wrapped in a patriotic flag. So, what's the takeaway here? The situation in Venezuela teaches us a crucial lesson about the limits of power. You can use military force to capture a leader. You can use political pressure to open a border. But you cannot issue an executive order to reverse 20 years of rust, and you cannot command a corporation to lose money. The oil executives didn't say no because they didn't want the oil. They said no because they are mathematicians of risk, and in this case, the risk was astronomical, and the timeline was a fantasy. Venezuela may one day be an energy superpower again, but it won't happen because of a raid. And it won't happen in 18 months. It will be a slow, expensive, and decade-long grind. And until the math changes, that oil is going to stay exactly where it is, deep underground, mixed with the mud, waiting for a reality that matches the rhetoric. Thanks for watching.